Hello and welcome back. My name is Josh, and today I wanted to briefly talk about SPACs. So, what are SPACs? SPACs are Special Purpose Acquisition Corps. They're basically blank check companies, and we saw a huge boom in SPACs. There's tons of videos out there talking about it, but basically it's another way for a company to go public. And I had a couple requests to do some videos on some SPAC companies. Um, uh, Desktop Metal and Hyliion, I think, were two requests. And I still might make those videos, but I wanted to talk about, um, use this to talk about something else, which is kind of, I'll call it flows, fund flows. So what is fund flows? It's basically where money's going. So, if we just look at the market today, we've had a really down day. We've had a pretty down week, actually. If you look at the last 5 days, we're down, the NASDAQ's down 5%. Um, and when the market does well or does poorly, typically certain investment classes become correlated and trade together. So this is the NASDAQ. So typically tech stocks will trade together when something that helps the tech industry, whether that's lower interest rates, because tech companies are typically growing, they typically trade together. When there's a down market day, tech typically does poorly, and what I'll call flight to safety stocks, which are safer stocks. So those are stocks with lots of cash, good dividend yield. Um, those typically do better. If we look at Berkshire Hathaway stock, I wonder if it did less poorly. You can see it actually was up to start the day because that's typically seen as a flight to safety. Hey, where do I want to park my money if we really have something gets hit hard? While very high growth stocks typically trade together. So that's like the ARK ETF, which are very risky cash flow negative companies. So these are typically all going to trade together. And that's typically based on the investor base. So what kinds of people invest in these kinds of companies? They're typically not retirees because these are companies that have no cash flows today. They're not paying a dividend. While dividend paying companies that are more safe and stable are typically held by older people, retirees, people who are looking to get some stability. So these kinds of investment classes trade in line. How does this relate back to SPACs? SPACs have a very specific type of investor base. So again, when a company's looking to go public, they have two main ways. There's IPO. The traditional IPO is you sell a bunch of shares to an investment bank. That investment bank then goes on a roadshow. They get some very large funds to buy big chunks of it, and then they push it to the open market. You'll typically see a big pop on the first day because their goal really is to get their insiders a big payout. So that's why people then start going direct listing. Direct listing is you don't sell it to an investment bank. You just say, hey, we're going to sell it on the open market initially. It's a little harder because you have to do price discovery. What's the right price? What's not the right price? And you don't see that big pop. Actually, a lot of these companies actually will see down days on the first day. Spotify had not the best one, and they were one of the first ones to do direct listing, and they're not as popular. And the last way is a SPAC. A SPAC is, again, it's a blank check company. A company has $10 million but no company, and then they go and they buy the company. So the company's already public, but doesn't actually have a company based on it. It's just a holding company. It's like, hey, I'm blank check company ABC. I'm going to go buy a company. Then they invest in a company, buy rights to that company, and then that then becomes the stock. So SPACs have been around for a really long time, but the number of SPACs has increased dramatically. We can see even here, they had a couple dozen per year, but you can see we had record-breaking years as we went into late 2020, early 2021. This is the number of deals per week. And we were previously having, again, no one even knew what a SPAC was until the last couple years because it was out there, but it's very rarely used. And it's become a much more popular vehicle. Now, there are some good things about SPACs. So some of the good things are that going public via an IPO is very expensive, and it leads to a lot of scrutiny on the company. And so typically only the very biggest, best companies were going public, and other companies were staying private much longer. And it led to fewer public companies. Actually, there were fewer public companies in the last 5 years than there were 50 years ago. Part of that's also the fact that there's lots more mergers and acquisitions today. Google buys up any small company that they think might compete. There's conglomerates. Um, and so that is not always good. We want to see more companies go public, and it allows the early stakeholders to liquidate and get some liquidity. So if you're an early shareholder in a private company and you're like, hey, I'm worth $10 million on paper, but I can't access that because there's no stock market. If you go public, you can sell those shares. So that's a good thing for sure. Um, However, a negative thing is that SPACs typically have attracted those kinds of businesses that are less blue chip. So again, if you're one of the best companies, you're just going to go IPO. And if you're not as reputable, you'll go SPAC. So you saw a lot of companies with a lot of hype and very little um, in the way of revenues or even products sometimes go public via SPAC because again, really all it is it's all about branding. Hey, typically what you do with a SPAC is you get what's called a sponsor. So that's someone who or to promote the company. So Chamath Palihapitiya was a one who took a bunch of companies public, and he basically was the promoter. He would write up, "Hey, here's a company. I think it's great." And because he's got a huge following due to his podcast, people listen and they go, "Wow, I believe in Chamath. He's made some great investments. I'll throw my money in." So you're basically trusting that promoter because while you can look at some there are some revenue numbers and stuff like that. SPACs have much looser restrictions on what they can do, so they can actually say what they think the future business will do. And typical IPOs can't give that kind of guidance for the future. Hey, here's how we think we're going to grow over the next 5 years. IPOs can't do that. They can, but SPACs can. So SPACs, basically, if they want to go public and they want to get a bunch of money, they're kind of encouraged to give the most optimistic view. Hey, if we capture just 5% of the market, we're going to be worth $20 billion. And look, we're only going public at $1 billion. This is a huge upside, And so they're very, um, what's the word I'm thinking of? Self-promotion. There's a lot of self-promotion with SPACs. And we saw again, there was a huge boom in SPACs. But if we actually look today, um, here you go. 70% of SPAC IPOs so far this year are trading below their $10 offer price. So typically, SPACs, again, because they're a blank check company, they start at about $10 typically. If we look at highly on stock, we can see here is that basically at $10, which is the cash value. Again, it's just a pot at $10. And then you can see it shot up because there's a ton of hype up to $50. Then kind of this post hangover. Oh, you know what? They have to actually make a real company. Are they going to be profitable? I don't know. Oh no. And now it's down. I mean, from the highs, it's down a ton. It's down 88%. But even from the cash value, it's down 40%. Because again, after the SPAC, it's got to be judged as a real company. And 70% of these companies are now trading in the same way below their cash value when they were initially just a pot of money. And of the SPACs that's ones that are pre-merger. So again, that's before the company merges. That's just they announce, hey, we're going to merge with this company. 58% are also below their offer price post-merger. So after they've already merged with another company, that would be more specific to Highland. These are really poor numbers. The last week obviously has been a bit of a bloodbath, but these are not good numbers. And if you actually look at the history of SPACs, you'll see the same thing shows up. It's most of these SPACs do very poorly. There's one person in a SPAC that does really well, and that's the promoter. Because all they get paid is, a Chamath, he will get a ton of shares basically for free because his job is to promote it. So just like how, you hire Kobe and you give Kobe a ton of money to promote some shoes, or LeBron, rest in peace, Kobe, to promote some shoes, he gets paid even if the shoes don't sell that well. If the shoes don't sell that well, now he might also get a cut of the profits to encourage him to hope that the shoes do well, but he gets paid one way or the other. That's the same with Chamath. He's going to get paid a ton of money to promote, and then he also gets some equity. So if it does well, he does even better. But even if it doesn't, he gets a good chunk. So I do not like SPACs for the for the basic reason that I find the incentives are not aligned. The incentive for the SPAC company is to find a company, even if it's not at a good price. Because if they don't find a company within 3 years, that pot of cash has to get returned to the shareholders. So again, they raise a bunch of money, they raise $100 million, they got to find a company, they have 3 years. If they don't find the company in 3 years, then they have to give that $100 million back. If they do find the company, however, they get paid for finding a company, they get the promote, they get some equity, and as you see, they can also see a big pop if they're actually good at promoting the company. Oops. So they're obviously incentivized to do a deal. And when you're trying to find a deal and you have a timeline, that means you're not always going to try and find the best deal, right? Oh, I found this company. I think it's only worth 30 million, but they're asking for 40 million. Sure, I guess I'll overprice it by, 33% because I want my promote. So again, the incentives to me are completely misaligned, which is why I try to stay away from SPACs. I did buy 2 SPACs, and they both, I won't say they burned me. I bought Pershing Square Tontine Holdings, which is Bill Ackman's, PSTH, because I think he's brilliant. But as you can see, it was priced at around 21. It went up. I did not sell. And now it's trading about 20. I actually think I sold for a slight loss. I think I sold it around 22 bucks. So I think I bought it. Yeah, I probably lost 5%, maybe 3%, not a lot. And then another one was Red Ball Acquisition Corp. This was a company that I don't think I've lost money on. I think I bought it right at 10 bucks, so it's still right there at 10 bucks. But they were rumored to be buying a sports team. And to me, how else are you going to buy a sports team? I think that's a differentiated asset. If you buy, the Red Sox or something like that, if you can own that, that's a unique asset class. And there's nothing else that's like that. It's not like, they say, oh, you should be in stocks and bonds and crypto and real estate and, diversified. I think that sports team ownership is its own kind of unique asset class, similar to how art is its own asset class. And I wanted a way to be correlated to that. Now, it ends up that they did not buy a sports team. They they merged with a company that SeatGeek, which does tickets. And I stuck in it. I didn't sell out. We'll see how it goes. I think it could be interesting, but it wasn't a ton of money, so I'm not overly optimistic, but we'll see how that one goes. But yeah, in general, I'm against SPAC investing. It's similar. The way I see it is the SPAC is almost similar to earlier stage investing. A real IPO is like if you buy a company that's been public for 20 years, you're getting pretty safe returns. If you buy a company that just went public, there's a lot more volatility. If you get a SPAC, there's even more volatility, and the death rate of these companies is much higher. Most SPACs, I think, in 5 years are going to be bankrupt, but the ones that win are going to be huge, and that's the difference. It's just like an angel investing. If there's a startup company and they say, hey, we want $5,000 to start a company, odds are that company is going to go bankrupt. But if they don't go bankrupt, you could make a ton of money. So that is the same way I see SPACs. It's much riskier. So if you are on that end of the risk spectrum, you can do that. But unfortunately, there is also correlation with how these things trade, which is why Hyliion's down, which is why Desktop Metal stock, that was a SPAC. You can see it's also way down. Again, these are both Hyliion and Desktop are about half the value of their of the value that they were initially pitched at. So again, this is when they merged with, and you can actually see they have very similar charts here. Huge run up, then crash. And again, this is nothing to do with the business. I don't know enough about the business to judge the business, but these are correlated with the markets because they're the same kind of investor base. And this kind of investor base is not someone who's going to say, I want to hold this company for 50 years. They're much more likely to be traders. And so when SPACs are down, you're going to see a lot more people running for the hills and trying to get their money out of these SPACs. So I still might do some research into them. But this is just my thoughts on SPACs in general and why you might see them all doing very poorly lately. So hopefully this was valuable. Let me know in the comment section below. Did you buy any SPACs? What are your thoughts on SPACs? Do you think they're a good investment, bad investment? Are you trying to just get the pop and then sell out, or are you avoiding them completely? Thanks so much and talk to you next time.